Investing can be a powerful tool for building wealth. It allows your money to grow over time. Stocks and mutual funds are two popular investment options. They offer the potential for significant returns. Stocks represent ownership in a company. When you buy stock, you buy a small piece of that company. Mutual funds pool money from many investors. They invest in a diversified portfolio of stocks, bonds, or other assets. Investing in the stock market can be intimidating for beginners. However, it's important to remember that you don't need to be an expert to get started. By understanding the basics of stocks and mutual funds, you can make informed decisions about your financial future. This guide will provide you with the essential knowledge to begin your investment journey. We'll explore the benefits and risks of stocks and mutual funds. We'll also offer practical tips to help you get started. When you buy stock in a company, you become a shareholder. As a shareholder, you own a small piece of that company. The value of your stock will fluctuate based on the company's performance. If the company does well, the value of your stock is likely to increase. Conversely, if the company struggles, the value of your stock may decrease. There are two main ways to earn money from stocks: capital appreciation and dividends. Capital appreciation refers to the increase in the value of your stock over time. Dividends are payments made by a company to its shareholders, typically on a quarterly basis. Investing in individual stocks can be risky. It's important to thoroughly research companies before investing. Consider factors such as their financial health, competitive landscape, and growth potential. Diversifying your portfolio by investing in multiple stocks can help mitigate risk. Remember that investing in the stock market involves risk. The value of your investments can fluctuate. It's important to invest for the long term and ride out market volatility. Mutual funds offer a convenient way to diversify your investment portfolio. A mutual fund pools money from many investors. It invests in a diversified basket of stocks, bonds, or other assets. This diversification helps to reduce risk. When you invest in a mutual fund, you are buying shares of the fund itself. The value of your shares will fluctuate based on the performance of the underlying assets held by the fund. Mutual funds are managed by professional fund managers. These managers select the assets for the fund and make investment decisions. They aim to achieve the fund's investment objectives. There are many different types of mutual funds available. Some funds focus on specific sectors or industries. Others invest in companies of a particular size or geographic region. Index funds are a type of mutual fund that tracks a specific market index. For example, an S&P 500 index fund would invest in the 500 largest publicly traded companies in the United States. Compounding is a powerful force that can work in your favor when investing. It refers to the process of earning interest on your initial investment, as well as on any accumulated interest. Over time, compounding can significantly grow your wealth. To illustrate the power of compounding, let's consider an example. Imagine you invest $10,000 in a mutual fund that earns an average annual return of 7%. After the first year, your investment would grow to $10,700, a $700 gain. In the second year, you would earn interest on both your initial investment of $10,000 and the $700 gain from the previous year. This compounding effect continues year after year. The longer you stay invested, the more time your money has to compound. This is why it's important to start investing early and remain invested for the long term. Even small contributions made consistently over time can grow into a substantial nest egg. To maximize the benefits of compounding, consider reinvesting any dividends or capital gains you earn from your investments. By doing so, you'll be putting your money to work and accelerating the growth of your portfolio. Section 5. Managing risk, diversification, and long-term perspective. Investing in the stock market involves inherent risks. However, there are strategies you can employ to mitigate these risks and protect your investments. Diversification and a long-term perspective are crucial aspects of risk management. Diversification involves spreading your investments across different asset classes, sectors, and geographic regions. By not putting all your eggs in one basket, you reduce the impact of any single investment performing poorly. If one investment declines in value, others may rise, offsetting potential losses. A long-term perspective is essential for weathering market fluctuations. The stock market is cyclical, experiencing periods of growth and decline. By investing for the long haul, you can ride out these fluctuations and benefit from the overall upward trend of the market. Remember that past performance is not indicative of future results. However, historically, the stock market has trended upwards over long periods. By staying invested and maintaining a diversified portfolio, you increase your chances of achieving your financial goals. Section 6. Getting started. Opening an account and choosing investments. Once you understand the basics of stocks and mutual funds, you can start investing. The first step is to open an investment account. You can open an account with a brokerage firm, bank, or online investment platform. When choosing an investment account, consider factors such as fees, account minimums, and the range of investment options available. It's also essential to choose a reputable and trustworthy institution. Once you have an account, you can start choosing investments. Begin by determining your investment goals, risk tolerance, and time horizon. If you're investing for retirement, for example, you have a longer time horizon than if you're saving for a down payment on a house. If you're new to investing, starting with a diversified portfolio of low-cost index funds is a prudent approach. Index funds track a specific market index, providing broad market exposure. They also tend to have lower fees than actively managed funds. Section 7. Seeking professional advice. Finding a trusted financial advisor. If you're feeling overwhelmed or unsure about how to get started with investing, seeking professional advice from a financial advisor can be beneficial. A financial advisor can provide personalized guidance based on your financial situation, goals, and risk tolerance. When choosing a financial advisor, look for someone who is certified, experienced, and trustworthy. Certified financial planners, or CFPs, are held to a high ethical standard and are required to act in their clients' best interests. A financial advisor can help you define your financial goals, create a personalized investment plan, and provide ongoing guidance and support. They will work with you to understand your aspirations and develop a roadmap to achieve them. Based on your risk tolerance, time horizon, and financial goals, they will recommend suitable investments. They can answer your questions, address your concerns, and adjust your investment plan as needed. Remember that financial advisors typically charge fees for their services. Be sure to understand their fee structure before engaging their services. Section 8. Patience and discipline. Keys to successful investing. Investing is a marathon, not a sprint. Patience and discipline are essential virtues for successful investing. It's crucial to avoid making impulsive decisions based on short-term market fluctuations or emotional reactions. Don't get discouraged if your investments don't perform as well as expected in the short term. Remember that the stock market is cyclical, and downturns are a natural part of the investing journey. By staying invested and maintaining a long-term perspective, you increase your chances of success. Avoid trying to time the market. It's impossible to consistently predict when the market will rise or fall. Instead, focus on building a diversified portfolio that aligns with your investment goals and risk tolerance. Regularly review your investment portfolio and make adjustments as needed. Your financial situation, goals, and risk tolerance may change over time, and your investment portfolio should reflect these changes. Section 9. The importance of investing. Securing your financial future. Investing is not just about accumulating wealth, it's about securing your financial future and achieving your dreams. Whether you're saving for retirement, a down payment on a house, or your children's education, investing can help you reach your financial goals faster. By investing your money, you're putting it to work for you. Your money has the potential to grow significantly over time through the power of compounding. The earlier you start investing, the more time your money has to compound and grow. Investing also helps to protect your savings from inflation. Inflation erodes the purchasing power of your money over time. By investing in assets that outpace inflation, you can maintain the value of your savings. Investing can be a daunting prospect, but it's an essential aspect of financial well-being. By understanding the basics, seeking professional advice when needed, and staying disciplined, you can harness the power of investing to create a brighter financial future.